All right, let's do this. We're going to take a little trip back in time, all the way to 1987, to dig into a masterclass in business and investing from, well, one of the best there is, Warren Buffett. We're going to pull apart his annual letter from that year to uncover some core principles that are, believe it or not, more relevant today than ever. 23.1%. I mean, just look at that number. That was the compounded annual growth rate of Berkshire Hathaway's book value for the 23 years leading up to 1987. I mean, that is just an unbelievable track record. And it really makes you wonder, so yeah, that's the big question, right? What's the secret sauce? How on earth do you achieve that kind of consistent long-term success? Well, Buffett himself is pretty clear about where you won't find the answer. He says, straight up, it's not in the accounting books. I mean, think about it. He points to companies like LTV and Baldwin United. Right before they went bankrupt, their book values were in the hundreds of millions. The numbers on the page looked just fine, but the businesses themselves were basically worthless. So this is where we get to a really key idea. Buffett draws this bright line between a company's book value, the number you see in the financial statements, and its true underlying business value. And for Buffett, well, only one of those really matters at all. Yeah, this is the real scoreboard. This is what it's all about. Buffett's goal was never just to grow some accounting number. It was to grow the actual, intrinsic value of the businesses he owned. So how'd he do it? Well, that brings us to the first big principle. And you know what? The first secret? It's not some complicated financial formula. It's people. Specifically, the incredible managers running Berkshire's core businesses, a group that Buffett affectionately called the Sainted Seven. And here they are. Take a look. A newspaper, a uniform company, you've got vacuums, furniture, manufacturing, candy, and encyclopedias. I mean, let's be honest, on paper, it doesn't exactly scream high-octane excitement, right? But what these companies accomplished, well, that was anything but boring. 57%. Just let that sink in for a second. That was the combined after-tax return on equity these 7 businesses cranked out in 1987. To put that into perspective, a Fortune magazine study around that time found that the single best performer out of 1,000 top companies had a return of just over 40%. So Berkshire's boring little businesses, yeah, they were in a completely different league. And you know who Buffett credits for this? 100% the managers. And this isn't just some standard CEO lip service. It's a deeply held belief that great people are the engine behind great results. He says his job is mostly just to applaud them, but it's informed applause. He knows what he's cheering for. And really, there is no better example of this than Mrs. B. That's Rose Blumkin from the Nebraska Furniture Mart. I mean, get this. At 94 years old, she was still working 7 days a week, buying, selling, and managing. Buffett even joked that he had to convince the board to get rid of their mandatory retirement at 100 policy. That's the kind of person we're talking about here. That kind of talent, that energy, that's where those amazing returns come from. Okay, so that builds right into our second principle, and this one is kind of counterintuitive. See, while most investors are out there chasing the next big, exciting thing, Buffett's whole approach is the complete opposite. For him, boring is beautiful. And this slide really captures the two different mindsets, right? On one side, you've got the dreamers portfolio. They're all about feverish change and exotic-sounding businesses. They're fantasizing about the future. But then you have the Berkshire way. It's all about finding a fortress-like franchise in a totally mundane business that faces today's realities, not tomorrow's fantasies. And here's the kicker. Here's why that matters. The big point is that a business that's always going through major changes is also a business that's facing constant chances to make a huge mistake. It's just really, really hard to build a fortress on ground that's constantly shaking, right? Stability. That's where the real money is made over the long haul. So what's the secret for these managers of so-called boring businesses? Well, they just do ordinary things, but they do them exceptionally, obsessively well. They protect their turf, they're fanatics about controlling costs, and they just work harder than anyone else at the details. It's all about relentless execution, not some revolutionary new idea. All right, this brings us to the third and final principle, and this is probably the most famous lesson from Buffett of all time. It's all about having the right mindset, the right attitude toward the stock market. And to explain it, he asks us to imagine we have a business partner, a guy he calls Mr. Market. So who is this Mr. Market? Well, he's a pretty fascinating character. He's your partner in a business, and every single day, without fail, he shows up and names a price at which he'll either buy you out or sell you his share. The only catch? He has, as Buffett puts it, incurable emotional problems.
So some days, Mr. Market is just on top of the world. He's totally euphoric, he sees nothing but blue skies ahead, and he'll name this ridiculously high price for your shares. But then other days, oh boy, he's completely depressed, sees nothing but doom and gloom, and he'll offer to sell you his shares for next to nothing. And here's the most important part. You are always in control. You can just ignore him completely, or you can take advantage of him when he's being a fool.
And this, right here, is the single most important lesson of the whole story. Mr. Market is there to serve you, not to guide you. His crazy mood swings are an opportunity for you to be rational. They are not a signal for you to become emotional. You should never, ever let his anxiety or his giddiness sway your own judgment. To put it as simply as possible, his pocketbook is useful. His wisdom is not. Use his money when he messes up, but never, ever listen to what he has to say. And this famous quote from Buffett's own mentor, the legendary Ben Graham, just wraps this whole philosophy up perfectly. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Day to day, it's just a popularity contest, but over the long haul, it's a scale, and the true substance, the real value of a business, that will always eventually show up on the scale. So that kind of leaves us with one big final thought, doesn't it? These principles are from 1987. But think about our world today. With the 24/7 news cycle, social media, crypto, constant noise, they are more critical than ever. That voting machine is louder and more distracting than it has ever been. So the real question for all of us is, how do you build your own weighing machine? How do you tune out that noise and focus only on what truly counts?